The stock market is down, and yet earnings growth has been very strong. How can we possibly square those contradictory facts? Well, it turns out if you dig into the numbers for this earnings season, it actually does make a lot of sense. And that also has a bearing on what's going to happen to equities towards the end of this year. So if you do want to learn more about that and also about how to invest, then a great way to do that is by signing up for our free weekly market roundup. We try to keep it interesting, and of course, it's free to your inbox every week. If you want to do that, there's a link in the description and beside me. So now let's look at what's happening to the US equity market in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. Let's start off by looking at that earnings growth. The blue numbers you can see here are the profits or earnings generated by all of the companies in the S&P 500. Now on average that grows by about 6% per year, but you can see there was a bit of a growth hiatus between Q3 2018 and Q4 2019. And then of course we had the pandemic and we had 2 successive quarters when earnings fell. Then in Q3 and Q4 of 2020, we had that rebound, and we're just coming to the end of the quarterly earnings season for Q1 2021. And so far it's looking like it's going to be about $50 of earnings generated. Now that's way above where we were 1 year ago, when the earnings were just $33.35. So just as we saw with the inflation numbers recently, we've got a very strong base effect here, where 12 months ago we had very weak earnings. Now we've got the very large rebound, and consequently the year-on-year growth is absolutely huge. And that won't be the end of it, because the numbers were even weaker in Q2 2020. So the base effect will get even larger in the next earnings season in 3 months' time. Only when we get to Q3 will we see things start to level out again and just see that normal grind upwards in earnings that we have most of the time, hopefully. So if we switch to year-on-year growth in earnings, which is what these vertical bars represent, you can see that very large year-on-year growth for Q1. The latest estimates, I think, put that at about 50%, which is the largest growth for a decade. But then the forecast is for year-on-year growth in Q2 to be even larger. Now, normally what you see is that analysts are very bullish on the prospect for equity. In fact, they're usually too bullish. But what happened in Q1 was exactly the opposite. The blue line here is the forecast for Q1 earnings for European equity, and the red line is the average forecast for the S&P 500. But the minute we started to get actual hard numbers for the earnings season, you can see that the analysts were revising up their numbers like crazy, such that they ended up more than doubling the earnings in Europe and pretty much the same for the US. Given that incredible earnings growth, you might expect that stocks would be soaring. But in fact, what we've actually seen is that the equity market upward momentum has actually started to tail off, and we're now about 3% below the peaks that we've seen this year. If we zoom out to the period going back to just before the global financial crisis, you can see that's hardly a disaster given the incredible returns we've had for over a decade. And certainly some of that pullback will be people taking profits after such an incredible bull run, which of course actually accelerated after the March sell-off last year. But another part of this story is to do with valuation. You'll often see equity analysts break down their forecast for future prices for the S&P, for example, into 2 components. The first component is psychological. It's how much people are willing to pay for the amount of profit generated by companies. And a really good characterization of that factor is exuberance. Other people call it animal spirits. When people are willing to take risk, they're willing to put more money on the table and to take more equity risk, and that pushes up prices. But the second component is critical, and that's actual generation of profit. If companies aren't growing their profits, then it takes a lot of exuberance to push up prices. Now that exuberance factor we can quantify using something called a price to earnings ratio, which is the number of dollars investors are willing to pay for every dollar of profit generated by those companies. Now equity markets go up because of the combination of these 2 things. Exuberance on one hand, which is to do with psychology and risk appetite from investors, and earnings, which is how much profit companies have actually managed to generate. Now this is the exuberance part of that equation, or the forward price to earnings ratio as it's called. And when the pandemic first hit, you can see that exuberance certainly took a dent and equity markets sold off, such that the price to earnings ratio fell to about 13 times. But very rapidly, equity markets entered a super exuberant phase. Some people called it the pandemania, and the price to earnings multiple shot up to multi-year highs. And for almost a year now, we've been at price to earnings multiples which are around 22 times. The dashed green line here is the 5-year average of exuberance, or the price to earnings multiple, and we're well above that number. And the 10-year average is even lower, at about 16 times. And one good way to think about that is as a fair value. But notice that valuations recently have fallen a little bit, which is interesting. And if we compare the price to earnings multiple with the value in March, it hasn't gone down because the numerator, which is the price of the S&P 500, has gone down. In fact, that's gone up by 3.5%. It's gone down because the forward 12-month earnings estimate has increased. So we're dividing by a bigger number because the earnings estimate has gone up by 7%, whereas the S&P 500 has only gone up by about half as much. But the overall effect on the forward PE isn't huge. It's only gone down from 21.8 to 21. So the equity market in the US is still very expensive. Now, as interest rates have increased, that's become harder to justify. If US Treasuries are earning almost nothing, then you can justify high valuations. But bond yields have doubled, and yet equity market valuations haven't really changed much. So in order to justify such incredibly high prices for equity, earnings growth is going to have to continue to be spectacular. One reason why that may fail to happen is very rapidly rising input costs. As part of their FactSet earnings report, some poor people have to sit through these earnings calls for every single company and count how often somebody says the word inflation. And in fact, they've been monitoring that every quarter all the way back to 2010. And recently, after a lull during Q1 and Q2 last year, that started to shoot up. In fact, the word inflation was used in Q1 more than at any time over the last decade. Now, we're all familiar with the huge increase in commodity prices, in lumber prices, and that's because of the bottlenecks that we're seeing in the supply chains around the world. As activity increases, many of the suppliers are struggling to meet up with that increased demand, and that's put an upward pressure on these input prices for some companies. And I say some companies deliberately because what FactSet also does is break down the mentions of inflation by sector. So for these sectors which are on the left-hand side of the graph, you can see that many of the companies cited the word inflation. Consumer staples companies, materials companies, and industrials, for example, said the word inflation in between 60 and 80% of their earnings calls. Whereas cost for services companies are much more dependent on wages. So for example, in communication services, not a single company mentioned the word inflation. Similarly for healthcare, information technology, even financials only mentioned it in about 35% of the calls. So if you want to guess which sectors are going to be affected by the supply chain bottlenecks, look at the left-hand side of this graph. The reason why this matters is that this will affect profit margins. So let's imagine for a moment that you and I are the bosses of a company in the industrial sector. Our costs are going through the roof because of the very high prices of materials which we have to source to produce our finished goods. So we've got two choices. Either we pass on those increased costs to our customers, alternatively, we could take the hit. We could simply not raise our prices for our goods and simply reduce our margins. But again, that's going to hurt our bottom line, our profits. So really, this can't be a good news story for any of these companies which have very thin margins. And that's what this graph shows. It shows you the levels of margin across different sectors. And it shows you the number most recently, that's Q1 2021. That's the dark blue bar. And you can see for these four sectors on the right, the margins are all significantly below 10%. So if these companies see their margins eroded, they've got very little wiggle room. Whereas these companies on the left-hand side of the graph, such as real estate, information technology, financials, could erode their margins significantly and still be profitable. So certainly for some sectors, there's going to be difficulty generating good earnings in the quarters ahead. But that's certainly not true of all sectors. How about risk appetite, which was the exuberance part of our pricing equation? Well, certainly in the cryptocurrency sector, we've seen a huge reduction in risk appetite. There's been a huge sell-off in all the largest cryptocurrencies. So far, that hasn't spilt over into the broad equity markets, but it could. And the reason for that is that many of the new entrants to the equity market also trade cryptocurrency. And if you've been bruised in one market, you can't help but think maybe I should take a little bit less risk in equity as well. Now, Goldman Sachs actually has an index of the 50 stocks which are most popular for retail investors. So that would be normal investors like you and I. And that index peaked in March and it's been grinding down ever since. Now, part of the reason for that is that there's been less options trading. And in fact, the peak of options activity for retail investors coincided with the peak price of GameStop. That's not a coincidence. And if we look at trading flows by the largest US brokers, again, that's fallen since a peak in December 2020. So it certainly does look as if retail investors have stepped back somewhat from the equity market. They haven't completely taken risk off the table, but it's certainly starting to hit those popular stocks. And finally, people are getting more worried about the Fed tightening monetary policy. The Federal Reserve has just published its minutes from its April meeting. Now, if you remember, Jerome Powell famously said that he wasn't even talking about tapering, which is reducing bond purchases as part of their QE program. But what we saw in the minutes is that now they are talking about tapering. And the actual minutes said if the economy continued to make rapid progress toward the committee's goals, at some point in upcoming meetings, they will start discussing their plan for reducing the pace of asset purchases. So certainly for the sectors where margins are very small and input costs are rising, it'll be difficult to maintain margins and profits in the months ahead. And even for the tech sector where margins are very large, they're very sensitive to interest rate rises. And whenever the Fed mentions that, they tend to sell off. So no sector is completely safe. Now, I realize that these videos are very impersonal. I never know what you think about the things we discuss. But if you do join our community on Patreon, then we have a closer relationship. And I think it's a great way to learn about investing. If you do that, then you also get access to Slack, so you can chat to me and other members of the community. And we also make members-only videos, which will only be available to you as a member. Now, if you want to learn more about that, just click on the link beside me and in the description below me. And as always, thank you for listening.